Hi everybody, I'm Mike Gasior and this is my March 2009 video commentary. You have never seen this background before in one of my videos because I'm in beautiful Curacao. Currently at the Hilton Resort here and sitting at the pool deck near sunset, and it is gorgeous. I have never been here before myself and I'm really enjoying it. Although I'm adjusting to the temperature, I will say that much. What I decided to talk about this month, which I think is really important, is I'm getting the question, I'm getting a lot of questions, but over and over people wonder what happened with AIG. And I thought that would be the best thing for me to talk about. It's actually a two-part story. In a past commentary, I did talk about credit default swaps. This is a combination talk. What happened with AIG? And how did credit default swaps affect that story? Now, remember the basic premise of a credit default swap. Here's the way I'll explain them to anybody who asks me. Let's just say for the heck of it right now, if I were to look, let's say, at General Electric 5-year notes, basically General Electric bonds. General Electric is a very highly rated corporate issuer. But let's say I look and currently investors are demanding 300 basis points or 3% more return than they would accept on a comparable treasury security. Pretend, for the example, that I have some of these GE bonds and I would like to basically get that risk off my back. I might approach you and basically offer you this. I'd like to do a credit default swap. The swap will be this. I will pay you, just pay you 300 basis points on some notional, fictional amount of par value. So 300 basis points on perhaps $100 million. What we're going to swap is if these General Electric bonds, let's say, ever defaulted, or if they ever get downgraded in credit quality, you would owe me the market value decline on those General Electric bonds. So if General Electric, God forbid, should ever default and they go down by 50% in value, you would owe me that 50% market value decline. Or on $100 million, that would be $50 million. In the credit default swap marketplace, I'm buying protection. I'm buying protection. I'm paying you effectively to take that General Electric risk off my shoulders onto your shoulders. And I'm bringing up your rate of return to a level that is commensurate with the risk associated with General Electric debt. You are selling me protection. Just get used to that in the credit default swap marketplace. I'm buying protection, you're selling protection. AIG, who I, over my lifetime, my career, and during my ownership of the business I run now, have had tremendous respect for AIG, one of the world's most important insurance companies. Simply a division within AIG, if you think about credit default swaps, they resemble quite a bit insurance, if you think about it. Me paying you is not very dissimilar to buying life insurance, homeowners insurance, property casualty insurance. However, back in the year 2000, the U.S. Congress, on page 262 of some obscure legislation, was passed unanimously in the Senate to particularly exempt a product like credit default swaps from regulatory control. And remember who I'm blaming here. There's a lot of blame to go around for the financial situation we're in. Politicians have plenty to blame on themselves. Basically, as much as credit default swaps might be like insurance, they're not insurance, not in any sort of legal sense. See, in the United States and in most other jurisdictions around the world, if I sell you insurance, I'm heavily regulated. I have to have reserves. The regulators make sure that I have enough money to pay if your house burns down or if you die. The problem with credit default swaps for my friends at Lehman Brothers, my friends at Bear Stearns, and my friends at AIG is they weren't required to set aside reserves, money, for the day, should it ever come, that they would have to pay on these credit default swaps. The entities I just mentioned and many others sold protection, but they never put aside the money, or at least adequate money, to pay if they ever had to pay. That's why we're here right now. I don't want to go into a big political rant because you guys are used to me doing that. In the year 1907, in the early 1900s, there was a thing in New York City. They were referred to as bucket shops. They were gambling parlors. They were quite nice. Any of you who know how off-track betting is very much the same way. You can see the horse races, right, on the television screens. You can place your bets. Bucket shops were created for one purpose: to bet on the stock market. You didn't have to own any stocks. You didn't have to buy them. You didn't have to sell them short. You just bet on the stock market. Bucket shops were giving very widespread credit for creating the market panic of 1907. And politicians, knee-jerk as they usually are, rushed legislation into effect that outlaws bucket shops. If you operated one, it was a felony. They disappeared. There was legislation that if you want to speculate in the financial markets, well, you know what? Buy the stocks, buy the bonds, buy something, do something. Bucket shops were illegal. When the United States Congress passed this law back in 2000, making it basically, and they specifically exempted credit default swaps and similar products from bucket law legislation, is when the door swung wide open to allow for credit default swaps. So, this is where the problems began. It seems like an overly simplistic explanation. And I want to just make a point, and I'm not defending my friends on Wall Street, although I will do it all day long, but the truth is credit default swaps were an amazingly innovative and terrific product that, unfortunately, due to the lack of regulation and the misuse and the speculative nature of them for the people that sold protection. You're going to sell me protection. I'd like to know that you're going to have the money to pay me. So this is how we got to where we are today, but not exclusively. In an upcoming video, I'm going to talk to you about the relationship between the credit default swaps and the subprime mortgage-backed market. I have a personal experience. I just bought a house on foreclosure, and the homeowners who lost the house to foreclosure, actually, I've done the research, their mortgage ended up in a collateralized debt obligation, a CDO, issued by one of the major Wall Street banks. And it's been, I can't say fun, there's nothing fun about it, but I've been doing the forensic work so I can tell you the story of the circle of life. This poor couple who bought this house, got themselves over leveraged, took out a subprime mortgage, how that mortgage ended up in a CDO. And I'll just give you this much. I paid less than 1/3, 33 cents on the dollar, for the mortgage balance that they owed for the property that they lost. Imagine how the investors in the CDO are making out. But anyway, I apologize for the lag. I haven't done one of these in a while, but I'll be back. Curacao is beautiful. The sun is going down. And here's a hint. I learned of them because you guys know I'm in Cayman, the Cayman Islands all the time. In Cayman, they're called Cayman sunsets. I asked the bartender here if they had a drink sort of like what I was used to, and they said, yeah, that's a Curacao sunset. So my hint is, wherever you go, insert the name of the island plus sunset, and it's a good drink. Mostly rum, but a lot of alcohol. My favorite kind of thing. Hope you guys have all been well. I'm still here. Like Will Smith, I am legend. You know, I got all the mutants out there, but I'm still surviving. I hope you guys are surviving. I will see you soon in one of these video commentaries. Go visit my blog. I'm going to write a newsletter in a couple days. Thanks again for tuning in.